Today I'm talking to Richard Beddard. He's Interactive Investor's very own Share Sleuth. I like to think of him more as a forensic analyst. He's been ripping apart balance sheets, company accounts for years. He knows how to do it, does it incredibly well. He runs the Share Sleuth model portfolio and has invented a decision engine which makes investing simple. Now, I think I've got it right, but I'm not going to ask Richard where the FTSE 100 is today, because I know he won't know. And perhaps, Richard, you could tell me why you don't know where the FTSE 100 is. You don't like share prices, do you?
I don't even know how many thousand it is. I just don't pay any attention to it, basically. So if you tell me, I'll know. Is it 5,000 or is that the FTSE All Share? I don't know.
Yeah, it's about 5,000, just about 5,800, but it's almost irrelevant to you because share prices bear little relationship to the way you pick your shares. You don't look at a share price and necessarily think that's cheap. There are other metrics that are far more important to your decision-making process, aren't there?
Well, look, you know, the price alone can't tell you anything anyway. You have to compare it to something else, to what you're getting. So, yeah. To a trader, the price matters because you're interested in its direction. You're interested in whether it's going up or whether it's going down. If you're a long-term investor, then the price is only relevant insofar as it tells you something about the value of the company, and that's only relevant when you compare it to something else. So in that case, things are kind of turned on their head in many ways, and when prices go down, things get more interesting, and when prices go up, things get less, but you're not really looking at the price itself in judging that. You're looking at the price-earnings ratio, or the earnings yield, as I call it, or price to book. I mean, we have many different ways of trying to judge what the market thinks the value of a company is.
So perhaps you could tell us then how because you've been running the Share Sleuth portfolio for a number of years now. It doubled in value over a five-year period. You've also come up with the decision engine. Perhaps you could explain how the decision engine works, because it makes picking good companies that are perhaps undervalued more straightforward, doesn't it?
I don't know if it makes it more... I mean, first of all, I don't really know how it works precisely. It's changing all the time. I mean, it's just my way of visualizing what I think about things and trying to put some rigor into it as well, some financial rigor into it. So essentially, I'm a big believer in that your environment determines a lot of what you actually do. So if you're surrounded by the traditional indicators that tell us, that prompt our action, you know, my brokerage account right now might be showing red flags everywhere because prices are going down. I don't know because I don't look at it. But if what you hear in the news is right, and if prices are going down, then your shareholdings will be showing red arrows, and you'll be hearing on the news negative stories. Those things will be making you worry about the shares in your portfolio. You might be inclined to sell them. Now, if you're a long-term shareholder, what's happening today or tomorrow is unlikely to be of any relevance. So in my view, you need to surround yourself by stuff that is relevant. So in a sense, what the decision engine shows me is the valuations of those shares, the prices compared to those earnings. And I actually do literally have it going green when they're getting cheaper, the price is going down, if you like, and red when they're looking expensive. Or also I'm concerned with the quality of the company, so the same sort of thing happens with quality as well.
So Richard, for those people who haven't seen the decision engine in action, could you perhaps explain for us what it looks like and how it works?
Yeah, it's a giant spreadsheet. There's a page, a sheet for each company. So there's about 50 companies in the decision engine at the moment. Each one has a simple financial model that tells me important financial information about that company, how indebted it is, how profitable it is, that kind of thing. It works out the market's valuation of that company. And then also in that I feed in my sort of judgment. I'm interested in companies that I can invest in for a long time. That means that whatever they're good at now has to, in my opinion, be something that can last a long time. So there's a certain amount of business analysis that has to happen there. It's judgmental, that goes into, and then the shares are ranked on a summary page, so that the best companies, in my judgment, along with the are ranked most highly, so long as they're also cheaply have a good valuation. So at the top of the spreadsheet you have good companies at cheap prices, and at the bottom of the spreadsheet you have companies that I'm much less confident in, or companies that are expensive based on market valuations. And in the middle, obviously, there's sort of middling companies. The top ones are green, the bottom ones are red, the middle ones are yellow. It's a bit like a traffic light. So you can get a view of what I currently think right now about the shares that I follow.
Well, look, over the weekend I was reading your latest Companies for the Future article, and very interesting, but what does stick out is that 17 companies are flashing green on the spreadsheet at the moment. Now, does that mean they are all potential buys? I mean, what do your eyes lit up, a calming shade of green, you wrote. So for you, I mean, you've got 17 companies. Do you then think, well, okay, I'll consider the first few for the portfolio, or surely not all of them?
If I was starting a new portfolio today and I wanted to, I'd want it to be diversified. I'm not that confident in my own judgment, and I'm not that confident in the decision engine, if you like, which is sort of much the same thing in a way, that I could say that the top one is undoubtedly the best. Otherwise you'd put all your money in that. If you were 100% certain, wouldn't you? That would be the way to make bazillions of pounds. But unfortunately, I don't believe that's possible in the stock market. Certainly don't believe it's possible of me. So I would look to diversify. So yes, number 17 ranked, which is still green, may not be as good as the number 1 rank, but it's not a scientific thing. So in the interest of diversification, I would probably pick the top 15. I mean, I wouldn't do it without a bit more head scratching and making sure I'd got all my facts right, but you are seeing the product of my research, and so I would pick those. Yep, number 15 or 16 or 17 doesn't look as desirable in terms of statistics or in terms of as number 1, but then I could be wrong about that. So I'd spread the net wider to account for that.
Okay, Richard, thank you very much. I'm enlightened and understand how the decision engine works, and I shall be watching it very closely. Thank you.